Hello and welcome again to Money Tips. This is Charles Kelly bringing you money tips to help you save, earn, invest, accumulate and enjoy more money. Welcome to my viewers on Facebook Live. Hope you're all having a great day there. It's a Friday afternoon here in London and it's sunny. It's a beautiful day. So I'm going to do a short broadcast and then get out there and enjoy some of the sun. And today I want to talk to you about interest rates. And I mentioned this the other day that interest rates looks set to stay low for the foreseeable future. Certainly in America, in the UK, where it's the base rate is just 0.75%, the base rate, which is incredibly low. It went up slightly recently, but it doesn't look like it's going up that much in the future, near future. The ECB, the European Central Bank, has announced that it is reducing interest rates to near negative, and Trump is demanding that the US Federal Reserve also cuts rates, and the base rate, as I said, stands at 0.75 here in the UK, and other central banks are also doing the same sort of thing in other countries, and they're also doing things to stimulate the economy, which I'll talk about, things called quantitative easing, which I'll talk about in a second. And basically, they're pumping money into the economy. The European Central Bank are buying $2.8 billion or euros worth of bonds. Now, this is obviously good news for borrowers, but it does indicate that there are recessionary signs in Europe. Certainly Germany is slowing down, and countries like Italy, Spain, Portugal have got very high unemployment rates, so they've been in recession for a long time. And then you've got Britain trying to pull out of the EU, and that would reduce the EU's budget by 40 odd billion a year. So things are looking a bit shaky. China's slowing down as well, and then there's this trade war going on. So they're looking to stimulate the economy. But on the question of interest rates, it does look good for borrowers. I mean, you can get mortgages now at around about 1%. And you get fixed rates on a buy-to-let at just over 1.5%, fixed for a few years. I mean, that's an incredible rate, isn't it? When you think, even if you can buy a property where you can get, 4 or 5% yield, but you can borrow money at 1.5% fixed, that's not a bad deal, is it? So there's a margin there. And I think it's great. So for a borrower, but for savers, it's more difficult if they've got money in savings accounts and in pensions, annuities. It's not a good time for savers, but it is a good time if you want to invest and buy assets, which I've talked about many times on this podcast. Buying assets will always protect your money from long-term inflationary rates. So it should be a good time to go and fix your mortgage, because there's a price war going on at the moment in the UK on mortgages. So if you're on an ordinary variable rate mortgage, why not talk to your lender or talk to another lender and say, look, what deal can you do for me? It's crazy to just be on the standard variable. In fact, lenders make money from people who leave their mortgages on the standard variable rate, when all it takes to change that is sometimes just a phone call. You can do it on the phone, or you can see a broker and get the best rates on the market. But sometimes you don't even have to move your lender. You can actually do it by just staying with the same lender and saying, what deal can you offer me better than what I've got at the moment? Otherwise, you're paying hundreds and maybe thousands of pounds over the year more than you need to, just because you're a bit lazy and you don't want to change your mortgage deal or just change the rate with the same lender. The property market has been in a bit of a doldrum for the last couple of years since Brexit was announced. Prices in London have fallen fairly sharply. It's not a crash, but it's certainly a big correction. And average price rates rises through the rest of the UK are barely moving. Some parts of the UK are moving up by 1 or 2%, but it's barely moving. However, with the conclusion of Brexit, possibly finally in the end of it in sight, and no deal looks like it's off the table. According to Parliament, they've blocked a no deal Brexit. So some agents are reporting that there's a bit more activity out there. Maybe people have decided, look, we can't wait any longer. We want to go out and buy a property, or we want to sell this property. We're just going to go and do it, especially with low interest rates, low mortgage rates, and some bargains out there, I think. So, there seems to be an increase in buyer activity. This is anecdotal evidence that I've collected from local agents. It's got no economic proof there. But the mortgage activity that increases now in September may not show through in completion figures until maybe January or February. And then in January or February, they might say, well, there's been a rise last month in prices based on completions. Because a lot of these reports are based on completions, completed mortgages. Sometimes they're on mortgages issued. So they take a while to filter through. So if the market starts getting busy now again, and the auctions are busy, and the estate agents are busy, and solicitors are busy, those properties may not complete until towards the end of the year, and then they'll show through on figures in next year in 2020. But I think with the pound, although it's crept up a bit, the pound like 124 I think at the moment against the dollar, properties must look cheap for foreign buyers. I'm not sure why foreign buyers have slowed up in buying, maybe because of the increased stamp duty, but I'm sure that properties must look cheap here. And the pound just rose to the highest rate since July, and I think it will the pound will benefit from a Brexit bounce. I'm sure it's going to go up again. It's not going to stay at that level. I mean, it's almost at par with the euro. So, for European buyers, American buyers, Chinese buyers, this must look a cheap market for overseas buyers. And if you don't want to know how to get into that, just email me, charles@charleskelly.net, and we can introduce you to some people that can help you get into the UK property market. Now, I don't think, in the terms of the stock market, I don't think we've seen the end of market turbulence, although markets, as I said, have settled down. So I'm holding back on investing in the stock market and property. I will only buy property if I can see it's below market value, if there's a reason why I can get that at below market value. Now, just get on to another subject. I recently reported that the Chinese businessman Jack Ma said we should all work 12 hours a day, 6 days a week. He calls it the 996 formula, 9 till 9, 6 days a week. He said it was a blessing. But in the UK, some left-wing think tanks believe that we should push towards a 35-hour or 4-day working week, that we should all be working 4 days, because then we can have more leisure time, we can have more fun, we can enjoy life more. And we will all be more productive, won't we? That because we're working 4 days, we'll do as much work in 4 days as we do in 5 days. Well, maybe, I'm not so sure. It was introduced in 35-hour week was introduced in France many years ago, and economists agree that it has caused several problems. French companies are moving out. A lot of French people live in London because they can't stand the high taxes they're paying in France. A lot of French professionals. So it has its merits. You could argue that people are more productive if they work less hours, and certainly if you're starting to work more than 8 hours, your productivity level goes down as you become more tired. But I'm not sure how essential services could run if everyone said, well, we're going to work 4 days a week. What would you do? I mean, I'm just seeing hi to people coming on. Hi, Kyle. A nurse, for instance. So take a nurse, like somebody who's just coming on here. If all the nurses just said, right, we're going to work 40 hours a week, 4 days a week, then you'd have to employ a lot more staff, wouldn't you, to cover all the shifts. Same with doctors, or with the dustmen, the people who collect your garbage. If they do 5 days. So what are you going to do if you say, well, you can all work 4 days? They're not going to be able to collect the same amount of stuff in 4 days as they would in 5. So you'd need more staff, more. It's just crazy. So you can't force companies to pay people the same amount that they would pay for a 4-day week as they would for a 5-day week. I mean, it might work in some industries, in IT, where people can work from home and that sort of thing. And there is an argument for flexible working. But I think you can't just legislate from the top and then force companies to change their ways and pay people the same amount for 4-day work as they would for 5-day, because that would add 20% to their bottom line. In other news, I mentioned yesterday that the London Stock Exchange had received a bid from Hong Kong, but it looks like they're going to reject that bid, thank goodness. Can you imagine Hong Kong / China controlling the London stock market? It just beggars belief. The UK has a habit of selling off everything to overseas people, including their power supplies and their water. I think one of the water companies is owned by a Malaysian person. The Germans own a lot of our water and utilities. There's some things that are not open to just the free market. Sometimes you've got to control things, I believe, anyway. So the word of the day then. What is the word of the day? Well, I've mentioned something about it earlier, quantitative easing. In short, quantitative easing means central banks printing money. Now, they don't literally go and print money off the printing press and just give it out to everyone, although that has been done in Australia. The short answer is that they print money, but it means they're putting more money back into the economy. So when you had the 2008 crisis, central banks around the world pumped billions and billions and billions of dollars and pounds and euros into the market to buoy up liquidity. Otherwise, things could have been a lot worse. So it worked in that way. It works. In practice, quantitative easing is a monetary policy where central banks buys government bonds, which are it's basically lending money back to the government, or other financial assets in order to inject liquidity directly into the economy. That's the technical word for it. So if you hear quantitative easing, it's a fancy way of saying, well, we're just printing money or putting money back into the economy. I'm not an economist. I don't know exactly how this money filters down, but it certainly saved countries perhaps from going under. But it means that the banks and the countries and nations still owe trillions of dollars, and the deficit is still there, which could lead to further problems in the future. Remember, the government's bailed out banks to the extent of billions, and one of those banks, Lloyd's, is just coming out of that now, but it took a long time. It's more than 10 years since the financial crisis, and things have recovered, but who knows? Are we really out of it? I don't know. So thanks for listening, everybody. Thanks for everyone tuning in on Facebook. And you can catch my podcast on iTunes, Money Tips, or you can see my website, moneytipsdaily.com, where I also put a blog on, and we blog what we're telling you here. So thanks very much for listening, and have a great weekend, everybody.